Hello, hello learners and viewers. I am Dr. Chandradat Sutha, former Professor of Commerce at Government PG College and former Director Higher Education in Uttarakhand. I have discussed in the last lecture about the derivative markets basics. As you already know that derivative markets are not only have underlying assets from the financial instruments or financial markets, but also from the commodity markets like agriculture, base metals, bullions, and energy commodities. In this lecture, I'll be telling you the commodity markets and derivatives. After listening this lecture, you will be able to know the peculiarities of commodities as compared to financial assets, discuss the factors affecting commodity prices, understand the key economic functions performed by the derivative markets, know the market participants and entities and their role in commodity market ecosystem, and finally you can be able to understand the basic type of commodity derivatives as we have explained it, these basic type of commodity derivatives in the financial markets. Now you will learn these in what is how they function or work in the commodity derivative market. What is a commodity? FCRA defined a commodity that every kind of movable property other than actionable claims, money, and securities are excluded from commodities. And commodities include agricultural commodities as well as metals, minerals, etc. These are the different types of categories of commodities. At the first level, agricultural commodities like barley, maize, wheat, different types of cereals, spices, sugar, oil, cotton, etc., cotton jute. This comes in the agricultural category. The second category is energy category, in which you include crude oil and natural gas. These two items are included in energy. The third category is base metals like aluminium, brass, copper, nickel, lead, steel, and zinc. And the last category is called bullion, which includes gold, silver, and diamonds. The category of commodities can be classified in other way, like hard commodities and soft commodities. Hard commodities like basic metals and bullion, whereas the soft commodities includes agriculture and energy. In other way around, there are investment commodities like bullions, and there are consumption category, which includes agriculture, energy, and steel. What is the difference between commodities and financial products? As you already know, the financial products are financial instruments like shares, debentures, bonds, uh, different types of stock exchange indices. But commodities have some peculiarities, and commodities are different from financial products. Commodities trading have claims on real assets, agricultural products, metals, crude oil and gas, etc., which have physical property. But on the other hand, financial derivative have claims on financial instruments and assets like stocks, bonds, foreign exchange, stock indices, interest rates, etc. So these are not physical assets. Commodity prices are mainly the function of demand and supply, and also it is influenced by the seasonality, whereas these financial assets are influenced by the reputation of issuer of instrument besides interest and risk premium. Again, the financial assets are not influenced. The prices of financial assets are not actually impacted by the seasonality. Factors influencing commodity prices. There are so many factors which influence the prices of the commodity, like demand and supply, their seasonality, and the geopolitical environment, the micro um, economic environment. If there is a war-like situation in at global level, the prices will increase. Inflationary pressures, the high rate of interest also impact prices to another higher level. So there are so many factors which affect the prices of the commodity. One of the most important factor which influence the prices of the commodity is the uh, festival season. In festival season, the demand for the commodities increase, and therefore prices tends to be increased. Also, the harvesting season. In the harvesting season, the prices tends to be decreased. Whereas in the sowing season, the prices tends to be um, increased. So these are the seasonal factors. There are many weather like factors which also influence the demand and supply, and then consequently the prices of the commodities. Commodities are different from financial products in many counts. Commodities trading have claims on real assets, whereas financial assets have claim on different types of securities. And commodities are influenced by the seasonality, whereas the financial products are not influenced by the seasonality. Now, what is the need for regulation of a commodity derivative market? As already told you that commodity prices are very volatile and have the tendency of fluctuation. Price fluctuations are there. So dealing in commodity derivatives also have a lot of risk. Therefore, there is a need for regulation of a commodity derivative market. Commodity derivative market actually ensures the market integrity by effective surveillance and monitoring, financial integrity by ensuring the capital adequacy of exchanges, and also the intermediaries which play their role in the market, and payment of adequate margins by the intermediaries. Proper integration of spot and future prices. Actually, the exchanges give information about the prices, and the spot and future prices can be integrated. So by this information, the price can be explored and risk can be managed. There should be fairness and transparency in trading, clearing and settlement process, and also the investor in the derivative markets, or the party or broadly we can say the derivative markets participant must be protected against unsurplus intermediaries. Commodity in India, there are three main commodity exchanges. Number one is National Commodity and Derivative Exchange, which is called NASDAQ. The second category is National Multi Commodity Exchange (NME) and The third is multi commodity exchange, MCX. MCX is very popular, and more than 80% trade is done in MCX. Commodity derivatives means these are actually the contract between two parties. These are not commodities itself, but these are only contract to buy or sell a specified quantity and quality of a commodity at any future date and at certain prices agreed upon by them. You can distinguish that in commodity quality is very important factor more than uh, um, with as well as with quantity. The contract is entered into any commodity exchange, but OTC platform is not regulated. Commodity trading is trading in spot and derivatives or futures. Trading in commodity futures are quite similar as equity future trading. As already told, these are the uh, three types of exchanges. Financial derivatives, as I already have told you in the last lecture, last section, derivatives are of four kinds: forwards, futures, options, and swaps. Forwards are again categorized as spot delivery and future delivery. The main peculiarity of the commodity derivatives are that lot size and margins are already decided, already given. And this lot size and margins are different in different categories of uh, uh, commodities. Like in gold, there are four categories starting from 1 gram to 1 kg. In silver, it is from 1 kg to 30 kg, the lot size, and this is standardized. And in oil and gas, it is uh, again the uh, the category, the margin is already defined, and in aluminum it is 5000 kg, whereas in the zinc category it is 1000 kg. So these are the lot sizes, and margin is in bullion is 10%, whereas it is 12% in silver. Also, in oil, which is more fluctuating product, 18% margin is needed. So this lot size and margins are different in cases of different category of commodities, and within the different categories of commodities and the commodity itself, the particular commodity has a different type of lot size. Who participate in commodity derivative market? There is a ecosystem of derivative markets in which, like equity market, the first type of participant is hedgers. Hedgers include farmers, merchandisers, food processors, exporters, importers, warehouses, who have their own interest, own perception about prices, and who deal in the um, commodity market as risk transferer. They transfer risk to the speculators. Speculator, on the other hand, accept the risk. They are actually the writers of the contract, and they get premium as consideration. The third category is arbitrators. Arbitrators are actually benefited by the price differentials prevailing in the market. Commodity market ecosystem include besides hedgers, speculators, and arbitrators, there are warehouses, transporters, banks, and insurance companies, quality assurance and accreditation agencies which actually certify the quality of the product. The role of the warehouses is very important because warehouses issues different types of commodity receipts, and they help in the execution and implementation or the settlement of the contract. So there are so many participants and they play their role, and these are far more than the equity market. So commodity market ecosystem is wider than the equity market ecosystem. Now the question arises, why to invest in trading in commodities? Commodity trading helps leverage the uh, contract on assets, and the risk can be avoided while the profit anticipation may be increased. An investor can diversify its portfolio, and if there is uncertainty and volatility in share market, an investor can invest in commodities, and diminish decrease it will decrease its risk. Also there is a factor of liquidity, because investor has an opportunity to transfer different type of derivatives for one another and from one party to another, and it will benefit his liquidity position. Security is also there, because on the value of the underlying assets you can leverage your risk, you can hedge your risk and get a desired level of security. And there is transparency, because you know what are the prices of the commodities in the market, and on the base, and what are the anticipation of price increase or decrease. So an investor can be benefited by the differentials in prices through the use of the derivatives. The first type of derivative used in commodity market is forwards. Forwards are actually the contracts made at present between two parties but implemented at future. Contracts are done at present but they are implemented at future date. Both parties decide date, price, quantity at contract date. This is done at the commencement of the contract, where both parties agreed. At the same date, at the due date or expiry date, both parties have the obligation to honor the contract. One party will deliver the goods or the commodity and the other will pay. So at the due date, the seller has to give physical delivery of commodity to the buyer, and buyer has to pay the agreed price to the seller. Now you can understand the forward by an example. For example, a farmer who anticipates uh, the prices to be falling in any future date. So in order to avoid his risk exposure, he may enter into a contract with the miller and lock the for example, he is growing barley, so he can lock the barley price today and deliver the barley at any future date. Suppose the international standard contract size of barley is 50 tons and agreed contract price or strike price is 25,000 per ton, at which the delivery is to be given on a certain date after 3 months. On the expiry date, if spot prices of barley is 30,000, the farmer will get 5,000 per ton less, and this will be miller's gain because the exercise price is 25,000. If spot prices is lesser than the exercise prices of rupees 25,000, the farmer will gain. Seller of the contract will gain if spot prices of the barley is higher than exercise price. So, by entering into future contract, the risk of both parties are hedged against price fluctuations and both will be benefited. However, at expiry date, when the seller will deliver supply of barley and the miller will pay the price, the gain of farmer will be miller's loss and vice versa. The second type of uh, contract between uh, two parties about commodity derivatives is future. This is the second type of commodity derivative. Future contracts are just like forward contracts. The difference is in terms of standardization and operation of the contract. Standardization means the lot size is already defined and fixed, and operation of the contract means the there is no need to give the physical delivery. It can be transferred to other party or some third party. Forward contracts are bilateral and customized, which are not traded in organized exchanges, whereas the future are standardized and traded in organized stock exchanges. Future may be transferred to third party or on or before maturity. In India, it is not transferable. It is not actually transferable before the maturity. Short and long hedge. In this example, since the farmer is expecting to hold goods and sold the barley future, his action is called short hedge. On the other hand, the buyer of the future at fixed cost is having the long hedge in this case. Forward and futures are similar in terms of obligation because in both the cases the buyer or seller has to give the delivery and pay the price physically to honor the contract. So at the due date, the farmer has to give delivery of barley to the buyer. For example, in this case, the barley, it can be wheat or any other product also, and the buyer has to pay the agreed price to the seller. Thank you very, very much.